Move on for the time being. Then we have Charandeep Singh as well as Varun Daga, co-founders and fund managers at Girik Capital, who joins in. Good afternoon, gentlemen. Sorry we took a little bit of time to come to you all. First thing that's standing out, as per what you all have put out, your report that you all put out, is the healthy cash in books. So you all would be in a better position, I think, to allocate some money. Are you all planning on doing that? I think it's around 30% cash is what you're sitting on. The last time we spoke, you all were indicating that you all are going to be allocating some money. Do you all think the time has come to allocate the money, or do you all believe cash is the position, you rather sit on that for a little bit longer? Go ahead.
I'm happy to come in there. Hi, Nigel. How are you? And hello to all your viewers. Good afternoon.
Afternoon.
I think, we don't think about it like that. We don't really ever think about cash like a position, and that's what we mentioned last time as well. I think there's a method and a process to what we do, and that is essentially, we've had this view and belief for the last 13 years, ever since we started Girik, that we will systematically and in a process-driven manner cut or eliminate our losers. You see, for a lot of investors, that's something that's very difficult to do. It's generally very difficult to cut losers because nobody likes to take losses. But our belief is that as a process, if you have a good, robust risk management process that doesn't fight the market and it beats out losers consistently, this is what results in the cash. It's not that we are taking cash calls or trying to raise cash to find new opportunities. The first port of call is to get out of losers so that you protect capital on the downside and that you do not perform badly, and so that investor capital is protected. And to answer the second part of your question, are we finding new opportunities? We're consistently on the hunt for them. We're looking, actively looking to see new areas of leadership that could possibly emerge. And, as we find them, we will suitably deploy this cash.
Charandeep, I mean, that's a useful point to kind of press on for a bit longer. So when you say that process allows you to cut losers and so you stick with that process, so what's that point of no return where you decide to cut your losses?
Because I could speak to you about this for a week. It's not something that's it's not really a button that we press or a hard stop loss that we have. For us, obviously, when we get into businesses, we are buying them for the business. But we have a lot of alignment that we look at on the fund flow side. On whether that particular industry or the particular stock that we bought has potential to attract capital, if it can get fund flows, if the P ratios can expand. Many times that when it's going against you or when it's not working out for you, you have to at some point decide that it's time to get out. It's not worked. It's like admitting a mistake, right? The market's telling you made a mistake if you bought something expensive and it goes against you. So it's like admitting a mistake. Now, that doesn't mean that your fundamental thesis hasn't played out. Yeah. You could have been correct. The earnings could have played out. But there are such a variety of reasons in the market that are at play, which are beyond your control. So then capital protection takes precedent over everything else.
So then, I mean, you're making my point in a way. So you need to have some process, right? I mean, because if it's all discretionary with every position, then so you got to cut your losses at some. What is that point? Is what I'm trying to understand.
So I'll give you some data points. In Girik's history, the average loser where we've cut our losses is about 20 to 22%.
Okay.
Over the last 30 years.
Okay. It doesn't matter what you think of the business, the underlying fundamentals, prospects. 22%, you're out. I mean roughly.
Like I said again, I don't think it's that hard data point, but it's happened like that. You follow a process and it works out like this.
No, yeah, absolutely. Just wanted to clear that point, Nigel.
All right. I just want to clear a couple of points out there. Financials are a large part of your portfolio, and you'll have mentioned refiners as well in there. By refiners, it's only Reliance Industries, or are there other refiner companies as well that you're invested in?
Yeah, so yes, Reliance is our largest holding, has been, and I will caveat, like we should, that this is not advice and we're not rendering any advice on this call, and that should be duly noted. But yes, Reliance has been one of our larger holdings for some time, and it's not just refiners. We got into it for a variety of reasons. It has other businesses like the telecom business, which we like a lot, which you can see, and we like the earnings tailwind and the defensive nature of that business as of today, its inflation fighting capability. Also, yes, the refinery part, when we bought it, I must tell you that we didn't have very high expectations from it. We saw a cash flow machine. We saw reasonable growth in execution and return ratios over the years. And obviously, in the current environment, the entire oil company within Reliance, the petrochemical part and the refining part, has played out to our advantage.
Okay, all right, noted that. And I think the two largest positions will be Reliance Industries as well as Bharti Airtel, as per the last disclosures that you all have made, and what's up for our viewers on the screen as well. Well, Varun, let's get you into the conversation as well. And I'm just trying to compare the last fact sheet that you all put out and the current one. It appears that there has been cash that's been deployed in select sectors, namely financials as well as banking names. I think Bajaj Finance as well as ICICI Bank, the weightage on both those two have gone up. Financials is the way to go. Do you all believe that's the theme?
Yeah, so, I'll answer this question in two parts. First thing is that, we are trying to be very, very stock specific at this time, So, although we feel as an industry, your financials, consumer, IT, they have been lagging, So, we are trying to be very, very stock specific. We've seen that in the past, many of these financials come back well, and we are being very, very stock specific. But at the same time, we do have a policy of, not averaging a loser. So we are going to be extremely stock specific.
Okay, so are you expanding? I mean, in drawdowns, you can, because everything falls and the aggregate market falls, Varun, you could, what you own also falls, hopefully not as much as the rest, but you get opportunities to look at stuff you don't already own, so you can buy newer things. Is that something you're doing? I mean, if you can point in the general right direction, where would that be? Or are you adding on to what you already own? We have your portfolio in any case. Go on.
Sure. So, I'll give you an example. The last big fall was the COVID fall, where everything fell anywhere between 40 to 60%. And again, we went into capital protection, and our portfolio fell about 20 to 22%. I think where we protected is not because of just taking a cash call, but we also invested in some of the names that our screeners were showing, which were some of the pharma names that were coming up. So I think the idea is that in such times, in the times of correction, where everybody looks at weakness, let's buy something which is near 52-week low. Let's buy something that's fallen the most. I think we do something very different, where we are in fact looking for strength. So rather than looking at stocks which have fallen the most, we're looking at stocks which have fallen the least. So what that does is that it tells us that where the next round of leadership could emerge, which we saw during COVID. We saw some of the IT companies, some of the metal companies come up very fast, very early, and that really helped us. So, I think these corrections are the best times to look for strength, and all the cash that we've created, hopefully we go in and deploy in the ideas that are coming up, in the sectors that are coming up.
Okay.
And we are always, we are never in a hurry to just jump in very fast, because you never know how long this takes, right?
Okay, all right. Maybe, the markets have some more downside, but going by what you're saying, I think financials and IT may not be the new leaders for the bull market. Whenever the new phase does turn up, then what would the attention turn to? If not financials, not IT, who could be the new leaders, in the next phase of the bull market?
So, what we are seeing right now, and it's still too early to define that and to solidify that, but we are clearly seeing that the over-owned sectors like financials and IT are may not be the leaders of the next bull market. In fact, we are seeing that the under-owned stuff, which is like the capital goods, industrials, I think some of those stocks, and we have very good quality MNCs there, a lot of companies which are leaders in their space, and which with very little market cap compared to some of the financials and IT names. So we could see money flow move to some of those sectors. In fact, we're already seeing that, and we're also seeing that fundamentals are changing for after a very long time for many of these capital goods names or the industrials names, and there are some good companies out there. So I think that is where we are focusing our attention. Let's see what comes out.
All right, gentlemen, thank you very much for joining us. Good speaking with the both of you, and good luck as you navigate through this market correction that we have on our hands.